All right. Good afternoon, everyone. So I'm a bit of a walker and a talker. So I'm going to take this out. We're going to see how we can proceed through the afternoon. So thank you for the introduction. I certainly appreciate the opportunity to be here and speak with all of you this afternoon. And like Aaron suggested, so I'm Amanda Hammell. I work with MNP. And for those of you who are not particularly familiar about MNP, so we are a professional services firm. Most of you would know us from our accounting practice. That being said, I, along with my team, head up the Ontario sector when it comes to farm management consulting. And what does that do? Ultimately, you know what? We're here to support Ontario farmers and businesses and help them achieve some of their business goals. So whether that's through a further understanding of what their financials look like, whether that is looking at, cost of production and analysis and all that kind of stuff, that's some of the things that we do. Really, if there's a question or something you've got in your mind on your business, there's probably somebody, myself or my team, that can help. And so Jennifer asked me to participate in the program today. And so then when I got the agenda and I was looking at all the speakers, I'm like, oh, there's a lot of acronyms behind a lot of names. And I was like, I don't know if I'm smart enough to speak to this group. So then I thought, like, what kind of acronyms can I put behind my own name? I'm like mom, like Uber, because I'm an Uber driver. I got 3 teenage girls. Then I thought I'm a feed pusher. I'm a rock picker. But that's really all those ones. So wherever Jeff is, who's going to speak last, like, I can't wait to hear what you have to contribute. So like Aaron said, so it's a little bit about myself and pictures of around our farm. So the youngest, that's my youngest there. So she's 11. I think the only reason she goes to the barn and feed calves is so she can take selfies and post them. I think that's what most young girls do right now. But so she's kind of graduated to her like full-time calf feeding. She's pretty good at it. That's where we call home, is in the middle. And of course, if you have teenagers or girls, they're always doing something funny. And so that's my middle one in the tractor. And so when we're not on the farm, so we do run, a dairy. We've got about 20 purebred Angus that I consider my hobby or a tax write-off, or how I support my children from not being on their phones all day. So we do that. And then obviously this is where, when I'm not on the farm and I'm not on work, I am in the hockey arena or I am on a baseball field. So, one of the things about working at MNP is I've had to actually account for my time. Like when you're an accountant or you work in an accounting firm, I have to put my schedule in every 15 minutes. So I've adapted that to what I do at home with my husband. And when I tell him that hockey takes between 35 and 40 hours a week, he doesn't believe me. And believe me, now I've got the proof. So and then obviously livestock and 4-H is a big part of our community and a big part of what my family and what we do. So the kids do everything from, you will see there is no showing dairy. It's not really my wheelhouse, but we do enjoy showing sheep and beef, and that's what keeps them busy. So a little bit about what I'm going to talk about today. So we're going to talk about resilience and what does that mean. We're going to talk about a little bit about where we're at for capital access. And when I mean capital, that is, how do we grow our businesses? Are we structured right? How do we get more money into our farms? We're going to talk about margin protection, because obviously with those of you in the veal / beef / dairy industries, I mean, obviously we've seen a lot of margin increase. And so as we go through the next year and the next couple of years, what's the outlook look like, and how do we protect that margin? And then I'll give you a few, little tidbits of what I've seen. So, there's been a lot of things that I'd say, prior to myself joining MNP, I spent 20 years in the agricultural lending institution world. So I would sit at farmers' tables and we would go through financials. It is actually kind of neat, this side being on the other side. So now I'm right into your numbers rather than actually having the ability to look at it on the outside. So lots of experience that way. So we'll talk a little bit about what I think resilience means. And here's what, actually, you know what? I'm going to talk fast because it's just the way I do. So if I'm going too fast, just wave at me and I'll slow down. The next part is if you have questions, by all means, don't wait to the end. Let's make this interactive if that's okay. And if not, then we'll take some questions at the end. So what do I think resilience means, right? So the way I look at this is being agile in your business. How quickly can we rebound? How quickly can we absorb a market shock? How quickly can we look at, recovering from something that's difficult? This is what I think of resilience. And so as our businesses mature, how much more can we handle resilience? Are we more resilient? Are we less? I look at, my daughters playing hockey and they get knocked down and they bounce right back up. And I'm like, I'd roll around on the ice and climb on my knees before I could do it. So they're obviously more resilient than I am. But, what does that mean? And then, so I've kind of got 3 words up there at the very bottom there. And so in my mind, I think resilience means structure plus discipline plus flexibility. And so one might say, well, how can you be disciplined and flexible at the same time? And I think you can, right? So I think as we think about going into this coming spring and into the next year, so I think there's going to be a key word here, and I think it's going to be disciplined. I think we need to have some sort of structure when it comes to our business and looking at how we can adapt to change. And I'll go through that in a little bit. And then here's the reality, right? Invest where opportunities arise. So I always think, right, there's opportunity every which way we look at. So if there's an opportunity and we've got the ability to invest in that, we've got a farm that's resilient and can handle change. Meet short-term cash needs. And then the last one, right, and I'm actually going to talk a lot about working capital. That is one of the most important things in your business. If you don't know your working capital position right now, that is the one thing I will challenge you when we go home. And then we'll look at, transition across generations. And I spend a lot of time at tables with multi-generations. It's one of my favorite things to do. And the reality is a profitable business for someone that wants to take over is one that is excited, right? And so we want to make sure that we're creating businesses and opportunities for the next generation. And I think that's what happens when a resilient farm can do that. So there's 4, if we're going to write down a couple of key things, there's going to be 4 financial pillars that I think will build resiliency in your farm. So the first one's liquidity. We talked about cash and working capital, cost, discipline. This is knowing the true cost per unit or calf per pound, however you look at. Not just, well, I gross so many dollars, or it cost me X amount of dollars to put my crop in the ground, or it cost me X amount of dollars to buy my calves this year. This is about getting pretty granular and getting on a true unit cost. Capital structure, making sure we have the right debt with the right terms. And then decision quality is how do we actually make decisions? So I always say, right, we spend a lot of time about, going through the what ifs, right? And we could make 5 questions, we could have 10 questions, we could have 30 questions, because as farmers, we tend to actually go through and part of being able to adjudicate risk is actually doing some stress tests. So, some of the things we talk about in the livestock sector, or anything that I would say is non-supply managed, is what happens if our replacements or our inputs or whatever goes up 30%. I'm sure you guys already know kind of where that's at. But what happens if feed costs rise, 10, 15, 20? When we're sitting down and planning with our customers, lots of what we do is our sensitivity analysis, right? What happens if interest rates go up? And then, the last one is what happens if, barns collapse or something significant happens in our production model. And you don't have to have an answer for all of these, right? And the reality is the answer will change within every situation. So the challenge is just to be asking those questions and thinking outside of the box and seeing, how resilient is my farm to some of those, right? So, I pick on the bankers because that's what I know, right? So if all of my debt goes up 0.5%, can I still make my payments? If my feed goes up 10%, can I still, what's my margin going to do? If my feed goes down, right? If my feed's coming down, what are the implications of some of that and how does that work? So I always say that, it's some of the things that we think about, and there's lots. And I would, challenge you guys to go home and think about the what ifs on your farm, because every single situation is different and everybody has a different risk tolerance and tolerance for that. And then here's what I think, right? Resilience isn't built in the good years. It's built in the hard ones. And so for those, I've spent a lot of time in the livestock sector between hogs and beef. I spent a lot of time in the grain sector. I work with a lot of elevators. And the biggest thing we talk about, right, is we talk about averages and we talk about margins. And, I mean, the goal right now, and especially in the livestock with the pigs and the beef, is how do we protect our margin right now, right? Because it's eventually going to come down. And I am not going to predict on markets and prices and any of that, but that's where I think these are the years that we actually got to really fine tune our numbers and make sure that we know what we're doing, because I think this is what we have to look at. So we're going to talk a little bit, like I said, feel free, cut me off. All right, so we're going to talk a little bit about good debt versus risky debt. I never say bad debt, but good debt versus risky debt, right? And we need debt to grow, and there is a lot of good debt, and it works really well for our operations. We want to look at that. So a couple of key qualities. Good debt has a clear payback, right? So we actually know that we're gonna, I mean, I can pick on the quota because it's a simple, easy one, right? So I buy quota for 24,000 and I make so many dollars profit per kg. I know my return is 6.5 or 7 or 8 years or whatever the number is, right? That is a clear payback. That is a good investment, right? We know what that does. Something that's going to improve efficiency or lowers my cost. So it could be an adaptation to something in your feeding system, right? So you know what, instead of buying in my corn ground, I'm going to buy a mixed mill, right? And like there's things like that when we think about what can we do that we can look at driving efficiencies that we can lower that. The one thing I looked at is so we're actually, I did this on the weekend, so it's fresh in my head. So we have an A4 robot. I hope there's no robot farmers in here, or sellers. I mean, anyways, they quoted me. They're going to give me $50,000 to change out my robot. And I thought, oh, that's crap. I'm not that. I think it's worth more. But anyways, I'm not going to argue with them. So $50,000 to change it out. So I've did an analysis on my repairs and maintenance for the 3 years. It's going to be $165,000 to upgrade new. And you put that over 10 years. I'm like, well, principal only is $16,500. I'm like, my repairs and maintenance are between 10 and 12. That generates me no more cash flow. That's a bad idea. And then my husband's like, well, I think we should still do that. And then I'm like, and here is what happens in daily husband-wife conversations when you farm with your spouse. But in all fairness, right? So then I challenge, and the idea is it's not really good for my marriage some days, but we challenge each other back and forth, and we say, okay, well, what am I missing, right? Like, would we not be better to go to Grand River and say, I want a maintenance plan? And to protect those future repairs and maintenance. But those are some of the conversations that right now, like the speed of milk increasing, will it generate enough profits to justify the $5,000 I'm going to lose, right? It's a simple project, but those are some of the conversations when we talk about efficiency. And then matching term to asset life. So back to the robot example, right? How long should a robot last? 10 years, 15 years, right? The one we put in is 9 years old, and my husband's telling me that we need an upgrade. So really, I should have an amortization for 10 years, because at 10 years, it's going to be worn out, right? I remember when I went to go, I was very hormonal because I was very pregnant with our third child, and I walked into the dealership, and I'm like, I'd like to buy a van. And he's like, what are your payments? I don't know about my payments. I just want to know how much it's going to cost. Well, if we put it over 8 years, I'm like, 8 years for a minivan? That thing's going to be worn out, right? So it's kind of one of those things is let's talk about where we can match. So land, right? Like 20, 25, 30 years, however you want, right? Buildings should be about 20 or 25, depending on the industry you're in. Quota, all of those things should match the asset life. When we get into extended terms, it will impact our cash flow down the road, right? And as long as you're capable of understanding that, I mean, it's okay. But I also say too, remember guys, I was from a lending institution. Their job is to sell you money, right? Okay, then we talk a little bit about risky debt. So funds operating losses. So in an industry where we are cyclical and some years we make money and some years we don't make money, it's natural for your operating line to carry a little bit of that. But if you're a grain operation and you still owe money at the co-op for your inputs last year, and you still have to pay for your inputs this year, that's funding losses, right? So there is a difference, right? We naturally, and when we talk about resilience and with our business, we naturally have the ability to go up and down. We need a cushion. Lacks a repayment plan. We've all done something where we're like, we didn't really think that through very well. But then you should know that you should be able to get away with that. Something else is going to catch your attention. But if there's something that you buy that doesn't have a repayment plan, and then short-term money tied to long-term assets. So perfect example, I bought a tractor on my operating line, and now I don't have enough money to fill my barn of cattle, and I got to go to the bank. And then you say, well, you don't really need more of an operating line, but well, what did you do with all your money? And then I get his capital expenditures. And then I said, well, we've got the wrong structure. So those are some things that when I talk about good to risky debt. And you know what, guys, we can fix everything, right? Like, that's the idea. I mean, there's some things we go to an auction and it was a good deal, or we made a turn on cattle because it was the right moment. We can usually fix everything. And I talk a lot about this is about communication with your lender and with your team of advisors. So here's my kind of thought on when we were looking at matching finance to investment, right? So you got your investment on the left-hand side. So if you've got feed, you should be using your operating line. Equipment should be a term loan or lease unless you have cash. Barn upgrades, that is a long-term fixed plan usually, right? A barn is a longer-term asset. So that should be well into depending on the extension of the renovation, should be a longer term. Technology. So this would be, any system upgrades, any GPS systems. I think it probably should be a short-term loan, but again, ROI stands for your return on your investment. So judge that accordingly. So I'm going to slip into, cash flow is king. And I talk a lot about working capital, and working capital. Sometimes when I used to say the word margin to my beef farmers, they sometimes, I don't know if they'd kick me out of their office, but we are in a margin business. This is what we do in and day out. If you did a tally of your inventory every month, you will know if you are making money or not, right? So that is, take all your cattle, take a fair market value, take your feed at 75%. And do you have inventory that is more than your operating line? And you look at that margin, and that's what will tell you if you're making money or if you're losing money, right? And when I say money, it could be margin, maybe not true losses, right? So when we look at working capital, current assets, this is anything that will roll over in 12 months. So your inventory, so that's cattle, feed, supplies, any receivables, they turn over, any prepaids. This is all of your this is all current assets. Current liabilities is anything on your operating line, any short-term debt. So I've got it listed there. Feeder finance, ACC, any ag input line, anything that is designed to fund inputs or short-term assets, that should be included in your current assets. Accounts payable. And the one thing that I think a lot of people miss is your current portion of long-term debt. So that is the amount of principal that you are obligated to pay on all of your loans this year. And I've seen lots of accounting firms exclude it. I don't know why, but that should definitely be included in your working capital. So as long as all of your current assets equal more than your current liabilities, then you are in a positive working capital position. The greater this number, the higher this number, the more flexibility you have to withstanding a lot of those the margin and the shocks in the system, okay? So then we talk about what should happen with your operating credit. So operating credit is your operating line, or like I said, the perfect example is, okay, how are you on your operating line? Oh, I'm pretty good. I'm like, well, can I see a list of your payables? Yeah, that's not like I owe $500,000 in payables. That is operating credit. You are using somebody else's operating credit, but it's still yours, right? So it's really important to make sure that we're on side with that. I'd also say that when I talk about keeping your line pure, in an environment where calf prices have been jumping, and we need to make sure we have all of the available credit, keep your tractors off your line of credit, right? So just, I mean, there's lots of places to get capital, but I would say, that's what we try and do to be pure. Assess the limit on an annual basis, and that is at a minimum. I would challenge that probably most of you who are raising calves and buying calves probably have had to jump your limit more than once a year, right? Maybe it's a seasonal bulge, maybe it's whatever. Probably when you look at the price, and I've got some slides, but if I just look at the price of feeder cattle that have went up 30%, the reality is your operating line probably should go up 30%, right? But again, that takes time, and you got to put together a plan to get everybody on side, and then review your margin. And I talked about that. Some banks will insist, and some banks will insist on margining on either a monthly or a quarterly basis. Usually the margining determines based on your risk rating to the bank. It determines how much money you borrow. So depending on that, but it is something that I would like to see that most of my guys in any livestock, because we have to withstand the market swings, I think they should be assessing their margin. And then the last is, I've kind of beat this to death. So increase of operating line. So I pulled this off your guys' website. So when we talk about how we can withstand the price, right? So here's 2022. This is what you guys are paying for bob calves coming out, right? So like yours have went up like 150%, right? So something like that is a lot. Like those are huge increases. So my guess would be is that between 2022 and 2023, right? You're buying, but we could look at what the fat price or what the finished price or how you market your calves, what they were doing. In my opinion, there's been a lot of margin made in these last couple of years. The margins are now thin. But you guys are experts in your business, so you tell me. But I would guess when I look at what I see on the feeder cattle side, there's been a lot of money made on paper, and now we're trying to capitalize those increases. And so when you've got and these are your expenses, right? $100 a calf, $200, $500, $900, $1,500, right? I joke around with the kids. I say, like, make sure you give that calf mouth to mouth to get it out the door, right? Like, it's going to pay for your education. But the gist of it is that, when you look at things like that, so when you look at your costs, and so this is your cost. So when costs increase, you have to be reassessing your operating credit. There's no question. There's going to be profits in there. There's no question, but we really got to look at something like that. I do think, and I mean, again, I love learning, so please challenge me. The veal sector is very much, tied to the beef sector, right? And tied to the dairy sector. So, and we think about the shift of what's happened in the last number of years. So I would think I'm like most other dairy farmers. Our top 30%, 40% get bred AI, sexed heifer semen. Everything else gets bred beef. Right, so there'll be the odd Holstein calf that gets popped out because sex semen is not foolproof, but the reality is then what happens in your market. And so I actually had the opportunity. It was pretty cool. We went down to CattleCon, which is the National Beef Convention, and it was in Nashville this year, so it was really hard to be at work that week. But anyways, we had a great time, and but pretty cool. The Secretary of Health, which is RFK Jr., spoke about their new food guide. So he talked about how, it was 350 pages long, and he put a whole bunch of smart people in a room, and they got it down to 11 pages. And the gist of it is that, here we can look at everything that's at the top of this. And his point was to eat real food. So for all of those who've been living in a bubble for the last number of months and years, this is protein, right? Beef, cheese, milk, yogurt, right? All of our vegetables. They talk about this is the pyramid. This is what's going to drive our industry. And so there is a huge influx of protein, which is the business that we're in, right? And so I think the demand is here to stay. I'll share a couple of observations from that week, because I do think it generally ties to where you guys are at, right? So 2026 will be the smallest slaughter and production year in history. And those of you who are trying to buy pure veal calves will 100% know that we are in a very, very tight supply. Cattle herds beginning to show expansion. Assumption is that the Mexican border will reopen. They're taking a lot of cattle, and for those of you who follow the news, there's yards in Texas that are closing because they just can't get the cattle, but they take a lot of cattle. Once that opens, it's going to create more supply. We've got, essentially the beef demand has grown for the last 17 years. It's now at a 40-year high. But I will say, and one of my customers that I deal with all the time says this, right? Like, when it seems too good to be true, it probably is. And so I don't want to stand up here and be pessimistic. I want to stand up here and be realistic that, I think we've got to be really, really good at what we're doing and look at our margins. And because I do think that we've got to be protecting what we've got, because I'm not sure this is here to stay, at least at the level of what we've seen in the last couple of years. And this was interesting, right? Government policy can influence markets, is unpredictable, and can add volatility. And we all know that from our American counterpart. So I thought, what does this look like for you guys? So, veal remains a niche protein market. In my research, and like I said, you guys know this better than me, but your harvest has declined 30% in 2 years. So I think you're probably all feeling that. That comes from a supply issue. And so, and obviously you've had record high prices on the outset. Now we've got record high inputs, right? So there's our outlook right there is how do we now balance these input costs with our record high prices? How do we manage risk on thin margins? And of course, we've got to look at the supply environment. So getting back to margins. So I always like, right? And everybody's got a different way of looking at their business. So my best analogy is I deal with my guys with pigs, and they're like, oh, I make $50 a pig. And I'm like, okay. And, but they look at it, and every guy will be different. They'll look at gross margin less your cost of goods sold. Cost of goods sold is everything that it takes to grow that pig or grow that veal. So that would be vet, feed, purchase price, and probably marketing in there, right? So did you actually make $50 a pig? Yeah, on a high level, right? And same as in your operation, right? This is where we get granular. Then we've got so this is what I call our gross margin. Then I've got our operating margin. So we've got our revenue less our cost of goods sold. But guess what? Like, it took a tractor every day to feed that calf, or it took, a tractor every day to, put bedding in. It took a person, or we've got extra wages, and you've got to include yourself in wage, because I think we all eat groceries. So you've got to put yourself in that wage category. You know what? It took fuel to put in there. So now we've got our operating margin per pig or per animal or per unit, whatever you want to look at. But here's what I like to look at is what did we actually make at the end of the year after we took out that big fancy word that we like to call interest, because it is a big expense in some of our businesses, right? So now we've got what I call a net. This is a true profit per unit. So we've got after interest, it takes insurance, it takes property taxes. That's all our overhead. I would say that, there's businesses I deal with that we've got a pretty good handle on this. We're okay at this. We're not very good at this part. And so I think that's one thing that I would look at. And again, I think you've got to think in terms of units, not holistic. However you measure your business, if it's on calf output, if it's on gain, pounds, however you look at it, it's got to be on a per pound. And we can do it relatively easy. So and everything is on averages. It's going to be a rolling factor, but take how many cattle you finish, see how many pounds you put on, take your dollars, take everything and divide by pounds. That's how we get per unit costs. And if you need help or you have questions, like, by all means, that's what I'm here for, right? So the cost control, and I do, because I'm the pessimistic one in my marriage. I get that because I deal with numbers all day, and sometimes it's hard. And so I would say, the easy thing to do is when we're in a business and we're losing money is to cut costs. But I'm not sure that's the right answer all the time. And so, you know what? We want to protect our margin. And sometimes that's not about reducing spending. So some of the things that I've put down here is which costs drive performance. So, the easy one is And I'm no expert. I hear lots of things. So if you're a cattle feeder and you feed Experior and you're trying to reduce costs, probably the feed additive that adds a pile of gain to your animal is not the thing you cut. Right? So if you look at here and you've got what drives performance. So you want to make sure that you're still doing a very, very good job on what you're doing, right? Which costs don't move the needle? So property taxes, can't cut them. And it doesn't matter what we do, they're all going to be there. And insurance is always going to be there, right? So we can't cut those costs. So, the challenge is where's the variability hiding? And so, in the business of short supply, high demand, right? Like, how do you get creative on buying calves? I'm sure that's a question you guys wanted me to answer, and I don't have it. But other than, I look at it and I say, you know what? Some of the more progressive and the farmers I deal with, right, is continuous flow, is trying to get it where you're on the market all the time, you're buying all the time, you're selling all the time. Right? The goal of the business, I think, for the next couple of years is not to hit home runs. You've got to hit singles and doubles all the way through, right? Or bunt, right? So at the end of the day, we got to kind of get through and look at that. I talked a little bit about discipline. And so I think you've got to really look hard. Is this the time you double down and expand? Is this the time that we, build a barn to replace rather than expand? All of these things come down, and what will throw things off. And I did it. The first barn we built, and there was lots of uncertainty, and so we were going through the process. And I remember like it was yesterday. I go out to the barn and I go to put the new door up, and it's a chain, and I'm like, what? And I'm like, a chain. I'm like, Steve, is there no automatic door openers? He's like, it was going to be $2,500. I'm like, we just spent $1 million on a barn, and I now have to like roll up the door by myself, right? So things like that, I'd say, but that's how things get out of character, is that we say we're going to do things and we don't, right? And then small leaks add up, right? So underused equipment. Are we overcapitalized? Do we have too much iron around here? Should we be looking at reducing? How good is our inventory tracking? Can we do a better job with this? Delayed maintenance. You know what? I've put that off, and now it's just going to cost me too much money. And then obviously marketing decisions with no plans. So we're on the home stretch. I'm going to bring it all together, hopefully. So I kind of say, here's my gold standard. So if you are a farm and you want to propel yourself and you want to take this to the next level, here are the things I think you need to do. And one thing I will say, you don't need to do it all yourself. This is why we hire teams, and this is why we're advisors. I know it can get pretty lonely. I call it at the top, but you have lots of us are just by ourselves every day working in the barn, and you don't know who to go to. And so, when I think about the team of advisors that we have around our board, right? We have our vet, we have our nutritionist, we have our accountant, we have our banker, surround and ask those people questions. I think in anything that is non-supply managed and business that is looking at growing of any substantial scale, you've got to look at your numbers on a monthly cash flow. That's bookkeeping monthly. I think if you do it every quarter, it will help, but I think monthly really helps you get there. Make decisions with data and actual numbers, not like, well, I think it's this. And so the perfect example is my nutritionist will come out and he'll give me a value on my feed every year, and I'm like, well, where does he get that value for corn silage? Well, it's industry standard. I said, well, that's not my value. Right? So then I take all our yields and I take our input costs and I take our harvesting costs. Yeah, it'd be easy to take his, but that's not the true cost. And so all I'm doing is fooling myself if I don't know my own numbers. Plan financing proactively. So have those conversations, have that communication with your lender, whoever your people are that you advise or that you want to look into, and then communicate early with your advisors. And so I've left you guys with a lot of information. So here's what I would say. I want you to take one of these actions and kind of look at something. So identify one cost to analyze deeper. I don't care what it is. I just think you look at something that's on your income statement that you think you should do. I want you to go home and I want you to assess your own working capital. So take a fair market value of all your inventory, your feed, and make sure that it is more than your operating debt and more than your principal. Make sure you include that. If it's not, like, then you know what? I'd be reaching out to your team of advisors and see what we can do to fix that. Stress test the cash flow and revisit your debt structure. Make sure that we're actually properly financed. My closing thought is it's always good to ask for money when you've had a really good year. Right. So, I mean, and that's the reality is we got to be forward thinking. You want to ask for money that you think is going to grow your business and grow it appropriately. And so with that, I think I am out of time.